Watch out for these quality stocks that are down year to date. So in today's video, I'll be covering that portion as well as the market right now and some questions left in the comment section below. So let's talk about the quality stocks down year to date. And the first stock that I'll be talking about is Copart. So Copart is down 12% year to date. It is currently trading at a 32 times earnings and it is at its 52-week low. So what exactly does Copart do? This is basically the entire business. Yep, so that's their business model. What they do is they auction cars online. So they hold sort of like a duopoly with this other company called IAA. And for Copart, this is their entire business model. So when a car accidentally gets destroyed, the insurance company will deem whether or not the car is savable. And then if the car is not savable, if the cost to repair the car itself is more than the sale price of the car, then what they will do is they will pass the car to Copart and then Copart will sell the cars for them. And then Copart will take a percentage of the car sale price. And this is basically the entire business model. They have a platform for people to sell cars, to sell wrecked cars. So they're quite reliant on accidents happening. So for Copart, here are some of the metrics for the business. So your ROC is at around 18%, ROIC of 13%. ROIC has been decreasing over the past few years because the company has been piling up cash and they've also been investing into new lands, which are not really utilized as well. But for this company, the metrics are quite decent. So for Copart, there's a worry when it comes to the business itself as well as the management. The management has been piling up cash over the past few years already. In fact, now the cash is at around 10% of the entire market cap. But there's a counter argument to the piling up of cash as well, which is that Copart's management has been very good with the buybacks of the stock. So for example, close to 2020 when the stock dropped by quite a fair bit, the management actually piled in and bought in a lot of shares. Same thing for all the major dips in the stock. Currently, the management still hasn't bought back a lot of the shares because they likely still feel that the stock is expensive. So when the stock falls to a reasonable level, you can expect the management to come in to buy a lot of the shares, which is shareholder friendly as well. So for Copart, this is the DCF calculation. So the company needs to grow at 16% for the next 10 years to justify the price today. But free cash flow can easily explode to the upside if they lower their capex. So they're buying a lot of land, they're investing a lot into capex. And if they lower their capex, then you can see the free cash flow exploding again. But for this company, it's not cheap by any means. The company still requires a high growth rate, a high free cash flow growth rate for it to justify its valuation today. The next company that I'll be talking about is Adobe. So Adobe is down around 13% year to date. It is currently trading at 24 times earnings and it is near its 52-week low as well. So for Adobe, it holds the majority of your market share in your photo editing software market. So it holds around 60 to 70% of the entire market share in this portion. Currently now you have AI coming in as well. So for Adobe, you can expect the market share over the next few years to start shrinking. So for Adobe, there is something that no one talks about as well. So for Adobe, they recently released their Firefly app. And their Firefly app is a one-stop shop for all your different video generative softwares. So for example, creator can choose between Adobe's Firefly model or rely on third-party frontier AI from Google, the Veo 3 as well as OpenAI. One big advantage of using the Firefly app instead of going directly to OpenAI, Google or other Gen AI softwares is that it brings everything together in one place. That is especially useful if you're using multiple content generation platforms or a single project. So for Adobe, what they're doing is they're trying to be the distributor of AI, not so much the leader in terms of the software itself. And for Adobe, I view this as a decent move by management. But the problem with this is if they don't have anything proprietary, if they're selling other people's products, then the moat could easily erode away if Veo 3, for example, gains enough scale. So for Adobe, if you're to look at the metrics itself, the metrics for the company is just incredible. So ROC of 43%, ROIC of 26%, ROE of 52%. These metrics here are just stellar for any single company. And if you're to look at the fundamentals over the past few years, fundamentals have grown massively. So ROIC has grown from around 21% to 26%. This is a company that is fundamentally very strong, but the narrative for this company is not that good. So for Adobe, if you have to do a DCF calculation for this, the company is only required to grow at around 8% over the next 10 years, with a stock-based comp adjusted free cash flow of around $7.5 billion. So for Adobe, they're buying back a lot of shares as well, so you can expect the free cash flow per share to skyrocket over the next few years. So for Adobe, it's a company that is battling with AI, and until the company comes out with a strong AI product, the stock price will remain compressed. It's Google, but with an even bigger risk as well. So Google is currently leading with AI. Adobe is not doing so much in terms of AI. In fact, it is losing. It is relying on other software platforms and it is trying to rely on itself being the distributor, which is not sustainable over the long term, especially when all these different companies, they start to gain scale. If it gets stupidly cheap, then I'll consider this one. But for now, I'm staying out of Adobe. Next company that I'll be talking about is Novo Nordisk. So Novo Nordisk is down around 20% year to date. It is currently trading at an 18 times earnings. So for Novo Nordisk, this is their business model. They sell your Ozempic drug, the most well-known weight drug in the entire world. And for Novo Nordisk, the headwind is that they are losing share to another company, which is your Eli Lilly. So when it comes to drug selection, there are two main things that your patients will look out for. Number one is the cost. Cost-wise, Novo Nordisk is slightly lower than Eli Lilly, but that is not a very good thing as well because it signals lesser profit margins for Novo Nordisk. The second thing that your patients look out for is efficacy. So in terms of efficacy, Novo Nordisk is currently losing to Eli Lilly, and over here it's stated that patients who took Zepbound lost around 20.2% of their body weight over 72 weeks compared to 13.7% for your Wegovy recipients. So efficacy-wise, Novo Nordisk is losing, and that's why the stock price has been hit by quite a fair bit over the past year or so. It is now currently down around 50 or 60% from its all-time highs already. And for Novo Nordisk, another headwind for the stock as well is that their patents are nearing expiry. So their patents for their Ozempic as well as their Wegovy ends in 2032 in the US. And when that happens, the company will start to push for volumes and decrease their prices drastically as well. This will hurt Novo Nordisk margins over the next few years. And if they can't ramp up their production, then this will hurt their revenue as well. So for Novo Nordisk, there's a tailwind for the business. So your weight loss drug industry is projected to grow at around 30% for every single year up to 2030. So this is a trend that Novo Nordisk can definitely ride on. And for Novo Nordisk, the valuation is quite compelling as well. So over the past 5 years, the stock has never traded at a cheaper valuation. Currently, it's trading at an 18 times earnings, and at one point it went up to around a 50 times earnings as well. So for Novo Nordisk, I'll be avoiding this one. The business is too complex to understand. They have the pipelines, they have efficacy, they have all the different trials and all that. But if you're a pro in this space, the stock is trading at a reasonable valuation today and 18 times earnings growing at 15%. In fact, if the company can re-accelerate its growth to the levels of the weight loss drug industry, then you can definitely get a stock that will give you massive returns over the next few years. Next portion, I'll be talking about the markets today. So the markets right now are overbought. This is the Nasdaq. The Nasdaq has never been overbought since around 2018. It's been going up and up and up over the past 2 months. And for the S&P 500, it looks slightly overextended as well. So what should you be doing when the market is this overbought, when the market is this overextended? So this is what I'll be doing. This portion is for those that are interested in the technicals, but I usually ignore all this. It's just noise. No one can predict the markets to a level of certainty that is reliable. So it's a matter of probability, but I'll ignore and buy stocks when the price is right. So the markets are now overextended, sure, but I'll be ignoring all this. I'll be buying when the stock price becomes attractive again, and I'll be blocking out the macroeconomic noise, the stock market in the future as well. Next portion, I'll be talking about some questions left in the comment section. So the first one, it says, what price is good to buy Palantir? Thank you so much. So for Palantir, the problem with the stock is currently trading at a 500 times earnings. And even if the stock price halves from today, it is still trading at a 250 times earnings. So for a company to justify 250 times earnings, it has to grow its earnings at 20% over the next 10 years. 20% in net profits over the next 10 years. And for any company, I think it is almost impossible for you to do so. Unless Palantir becomes the next Amazon, it becomes the next Microsoft. If not, it is highly unlikely that buying a company at 250 times earnings will give you massive returns over the next few years. So for Palantir, I think it is a stock that is speculative. It is a stock that retail investors love. But the stock price today and the valuation simply doesn't make sense from a valuation standpoint, from a value investor standpoint. Next question, it says, hi Guan, would you share some of your SG stocks and any you are waiting to add? Banks look expensive, but I think there is some sense to buy SG stock since we are using the SGD for day-to-day expenses. Thank you. So these are my Singapore holdings. So I have some SIA, I have Capital Land Ascenders here, I have Mapletree Industrial, I have Mapletree Pan Asia, Capital Land Integrated Commercial Trust, as well as Fraser Centrepoint Trust. So the majority of this portfolio over here is made up by REITs because the earnings for your REITs were suppressed for a very long period of time, and it is currently still suppressed because of your high interest rate. So in terms of what stocks I'm looking at, I'm not actively looking at any Singapore stocks because a lot of them, they're expensive. I think the only cheap stock in Singapore right now is a company called Wilmer. Wilmer is facing some sort of legal issues currently, and the stock is not exactly high quality as well. As for our REITs here, I think a lot of them have run up by quite a fair bit already, and the highest quality ones here will be your Capital Land Integrated Commercial Trust, as well as your Fraser Centrepoint Trust. I think those two companies are the highest quality one in the entire REIT industry in Singapore. These companies here, they will just yield me a 6% dividend yield. on top of a few percentage points in terms of your capital gains. I can easily get 10% from this ones. So I don't think I'll be selling out of them unless there's a better opportunity in the future. I hope you guys have found this one useful and invest safe.